Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. He is noted value investor Vitaliy Katsenelson, and he is the Chief Investment Officer at Investment Management Associates, which is a value investing firm based in Denver, Colorado. He's also taught investing in finance for a number of years, and he's written articles for the institution. I'm reading off his bio. He's written monthly column for the Institutional Investor magazine and written articles for Financial Times, Barron's, Business Week, Christian Science Monitor, New York Post, and a long list of other ones. And most importantly, and this is how I found him, he's written 2 books. And he's written the little book of Sideways Markets, How to Make Money in Markets That Go Nowhere, and Active Value Investing. So thank you very much for joining us today on a podcast, Vitaliy.
It's my pleasure. Thank you.
Now, Vitaliy, our listener base, we tend to talk a lot about macroeconomic situation and commodities and things like this, but we're trying to broaden our horizons. I've had a lot of experience with value investing, but many of our listeners have not. So what type of mindset, what type of skill set, can you first please define what your definition of value investing is, maybe compared to other types of investing or trading strategies?
Sure. First of all, a value investor is an investor, and therefore a value investor looks at a stock as a business, and therefore you analyze a business first. And this is none of the things I'll tell you are original to me. This is like a value investing 101. But basically you look at a company, at the stock, as if you were buying the whole company. You analyze it. So you analyze it and you say, how much is it worth? And then by looking at the business risk, at the financial risk, at the growth profile, etc., you say, okay, how much discount to the fair value I need? Because if you buy it at fair value, you're not going to make that much money. What's the point?
Well, there's a lot of debate about what's fair value now because the Fed's printing a lot of money. But yeah, there's obviously Benjamin Graham's margin of safety, which I guess you can talk about a little bit too.
Yeah, so you basically look for margin of safety. Margin of safety has 2 purposes. Number one, it's there to protect you. In other words, if you got your fair value a little bit wrong, if things go bad, you bought at a discount to it, so you like to lose less money or not lose money at all. Number one. Number two, it becomes a source of the return. So in other words, if you bought $1 for 50 cents, when the 50 cents come back to $1, you're going to make money. So you know what? You are talking about the Fed and the interest rates, etc. Let me put it this way: when I do discounted cash flow analysis, when I value stocks today, when I do discounted cash flow analysis, I don't use 3% discount rate. I've been using 10% discount rate for the last 15 years, and that hasn't changed. So even if rates go up, and I'm using 10% discount rate, I'll be fine.
Okay, very, very good. And but I think our audience, everyone knows, has at least heard the name Benjamin Graham, and everyone's heard of Warren Buffett. Are these the only 2 value investors books that you have read, or what are some of the other value investors that you learned from?
No, I think one of my favorite value investors is Seth Klarman. He wrote a book, it's called Margin of Safety, believe it or not. And that book went out of print, 15 years ago. And so you can't really, if you can try to buy it on eBay, but you'll be paying $1,500. But if your listeners Google it, they may find a copy, on the internet. And I think Seth Klarman would not mind if they read it without buying it because it's not available. But I think it's probably one of the best books on value investing, to be honest. Another book I like is that written by Joe Greenblatt is called "You Can Be a Stock Market Genius," which I highly recommend. I think it's a terrific book.
Yeah, I've read all of Joel Greenblatt's books too. The ones on spin-offs, which I think are good value investments. There's been a lot of successful spin-offs that Joel Greenblatt has gone and done the data and shown how well they've done. And then also his little book too, the Little Blue Book That Beats the Market. I think that's really good for beginners to understand value investing.
Yes.
Okay, well, let's talk about then your specific value investing style. And you can talk about your books then this way. Is your specific value investing style? Because I know there's different types of value investing style. Some value investors they look for only sentiment. They look for stocks that are absolutely hated. You have the Sir John Templeton maximum pessimism type of value investors. You have value investors that look at 52-week lows. You have top-down, then bottom-up macroeconomic value investors who look for sectors and then go and do economic analysis on sectors, companies and sectors that are out of favor? Or are you just mostly a bottom-up guy who just does the looks for undervalued companies and you don't care as much about any macroeconomic factors?
Well, I kind of do everything. And then my point is, why limit yourself? And so sometimes I find I stumble on a company that's too cheap. So that's what I guess you would call it bottom up, right? Sometimes I look at a sector and I say, I think this sector will benefit from this development. So I look at the sector, I look for stocks in the sector. Sometimes I say, it looks this sector is bidden up. So let me see if there is something there. So I don't think there is any reason to limit yourself in how you in how you find stocks. I mean, I look at portfolio of other value investors I respect and see if they're seeing something I'm not. And so I try to find value any way I can. So I guess that's would be my answer.
Okay, and your type of value investing, are you willing then to buy resource stocks or technology stocks after they've gone down 90% or 85% or things like that, where the hot money, the momentum players, the trend trading guys have already driven the stock up and then the stock's crashed? Are those appealing to you, or are you only the type of value investor that's looking for a consumer, Warren Buffett type of consumer monopoly, durable competitive advantage, economic moat? Do you care a lot about the CapEx component, where a lot of it's going into research and development and stuff like that?
So one group of stocks that I don't buy are the ones that are the momentum chaser, the ones that are kind of momentum stocks. I don't buy those stocks.
Okay, so you won't even touch them then if they're down 90% and the
No,
stuff like that.
Listen, I think we are talking about different things. So are you talking about the X momentum stocks or the stocks that are making 52-week highs? Because this is confusing to me.
The stocks that used to be momentum stocks that still have good technologies, and the trend traders are now out of the stock, but the stock still has a pretty good underlying business, but the multiple has dropped a lot. The stock's at a 52-week low. It's maybe off like 80% from its 52-week high, but it's a technology stock, and there's a lot of there's a lot of value investors that won't touch technology stocks because they don't generate as much free cash flow because they have to spend so much money for research and development, as Warren Buffett really prescribes not to buy any technology stocks.
So let me put it this way. The stocks you describe, I have a portfolio of them. So I do buy them. But let me disagree with you on something you said. What you find, actually, technology companies most of the time generate very high free cash flows. Okay, I'm generalizing right now, but because they're different technology companies, but in general, technology companies don't have high capital expenditures. I'm not talking about like Intel when I say this, and I'm not talking about semiconductor companies. Okay, but if you just kind of put those aside, most of the time, if you look at, let's say, Cisco does not have very high capital expenditures. If you look at software companies are probably one of the best businesses out there, period, because they have very high recurrence of revenues and they have very little capital expenditures. So Warren Buffett does not like technology companies for a very different reason. He feels that he does not understand them. He feels that he cannot comfortably look 10 years out and say, this company has the moat, and therefore this company will be earning more money 10 years out than it's earning today. So I think that's why he does not buy technology.
And for our listeners out there, the moat that Vitaliy just described is the economic moat, as in what's their durable competitive advantage. And the thing with technology industries is you have a leader like Research in Motion. They had the best smartphone 6 or 7 years ago, and now Research in Motion is not doing as well. And Apple was a leader for many years in technology, and then Apple is starting to come back a little bit as those sectors become more and more competitive. So I think, have I done a good job of describing that, Vitaliy?
No, you did a perfect job. So like I said, you mentioned Apple. That's one of the stocks, that's a billion-dollar technology stock that used to be loved by momentum traders and now hated by them. So guess what? I own it. So yes, we love those companies because because you can basically buy a very good franchise. This has a lot of recurrence of revenues. They have usually good balance sheets and great cash flows. But the question is that Apple next for Research in Motion or not? And that's that's a different discussion. But
yeah, I think Apple's a very good bargain here at these prices. The people that were buying it at $700 a share when the Wall Street analysts were raising their price targets over $1,000, I thought it was ridiculous. And I actually thought Apple around 700 was going to crash because, you looked at just the people that own the stock and it was all the momentum traders, the trend trading hedge fund guys who are all buying it on leverage.
Yep.
Okay, so let's talk about your books now, Vitaliy. And can you just give our listeners a summary of your books, and then we'll get into some of maybe, if you're willing to, some of the sectors maybe you like where you see the most value, or a couple companies and where you see some value, where research maybe should do some, our listeners should do some more research on value.
Well, so my books, basically I wrote 2 books, but it's really like a book and a half. So my first book is called Active Value Investing. I started to write in 2005. I think it was published in 2007. And basically, in that book, which is, 300 pages, 100-something charts or 80 charts, okay, I make a case that we are in the market that's going to go up and down, a lot of volatility, but basically going to go sideways. So you're going to be at the same level, more or less, where we started in 2000. And then I spent about 200 pages describing the strategy for this market, Then in the 2010, Wiley came to me and said, would you mind taking your big book, the first book, and kind of simplifying it for an average investor, somebody who is sophisticated, but maybe an engineer or an architect or a doctor, or has an interest in investing, but who is not, who doesn't, who wants to learn about it. So I took my first book and basically simplified it. And that's how the little book of Sideways Markets came about. In fact, you mentioned Joe Greenblatt's The Little Book That Beats the Market. Joe Greenblatt started this series of the little books. And it's basically, I took the concepts in the first book, simplified them, updated them, added some more information. And and again, it talks about the sideways markets and the strategy for sideways markets. I would advise you your listeners to read the little book. It would take them 5 hours and 40 minutes to read it. And the reason I know that because it's also available in audio version, and that's how long the audio version is. So.
Okay, very, very good. And let's talk a little bit more about the main overriding theme of those 2 books. And you talk about sideways markets. Do you think these markets then are sideways because of the debt levels then of the public sector and the private sector and central banks' intervention into the markets and distorting capitalism?
No, not at all. The market cycles, and when I talk about market cycles right now, I talk about long-term secular cycles that usually last 5 years or longer. In the case, I'm talking about close to maybe 15, 20 years. They happen because if you think about stock prices go up and down in the long run for really 2 reasons. You have and that's a mathematical kind of equation. Earnings growth and price to earnings going up and down. Okay, so historically, earnings grew about 5 or 6% a year. And that's what the GDP grew, over the last 100 plus years. Okay. And then if the price to earnings stayed the same, you would basically make 5 or 6% a year from stock appreciation, and then you would make another 4 or 5% from dividends. So that's how you get 10, 11% return from stocks in the long run. So in other words, again, if price to earnings never changed, you would make 5% a year in earnings and 5%, 5% a year because price would go up, and that would happen because earnings went up, and 5% you would get from dividends, just to simplify it. Okay. However, price to earnings does not stay constant. Price to earnings is kind of like a pendulum that goes from one extreme to another. In the beginning of a bull market, it's low and it's below average, and it goes from below average, through average to above average. And then that's when the bull market ends, and when we enter into sideways markets, and then it goes from the very high level to average to below average and stays below average for a while. And that's what takes us into sideways market. So during bull markets, you have earnings growth, and price to earnings kind of helps you. So you make very high returns. And then during sideways markets, basically what helped you in your past now hurting you, because price to earnings is wiping out all the benefits you get from earnings growth. And that's what basically happens in the sideways markets.
So in other words, then, you're talking about the price to earnings. You're talking about the multiple the market is assigning on that earnings growth, where the earnings could be the same, and then the market just decides for whatever different factors that it wants to pay a lower multiple for the earnings. Is that correct?
Yeah, and it's driven. It's just driven by psychology. It's really psychology. People get overexcited, and the stocks become too expensive, and then when stocks become too expensive, the people get the people have high expectations. We should not mad because price to earnings stops going up. Okay, and price to earnings starts going the other way because people say, well, I don't want to own stocks because I used to make 15% a year. Now I'm only making 2 or 3, and so price to earnings starts to decline, and people basically get frustrated. Just think about this right now. I mean, the market is making new highs, but those new highs are, basically just slightly higher what they were 13 years ago.
Yeah, that's a really good point, Vitaliy. And unless people weren't in stocks at all and they were in cash, and then they went and bought stocks right after the 2008 market crash, they don't have a lot of gains to show for that long-term buy and hold strategy over the last 12 years.
You got it. Yeah.
So let's talk about sectors or things then that you're looking at specifically where you see value. Did you say you said you look at everything? Then is there any particular sectors then, maybe some commodity sectors, because some of the oil producing stocks or MLPs have gotten hammered in the last 6 months or 12 months. The gold stocks are down a lot. The silver stocks are down a lot. Do you think those are good value investing type of stocks, or do you think there's too much risk there for a normal value investor?
Well, let's break resource stocks into several categories. Okay, so you have oil stocks. Then you have a kind of hard commodities that would be like iron ore, etc. stocks. And then you have precious metals like gold and silver, etc. So if you look at, I'm a believer that Chinese economy right now is going through one of the biggest bubbles we ever seen in a recent history. And when this bubble bursts, the demand for commodities will decline substantially. Especially for iron ore and other hard commodities. The demand for oil will probably decline, but probably not as much, because if you have a lot of it is ruined by just automobiles, and I'm not sure that's going to change that much. But
yeah, I think their sorry to interrupt you, Vitaliy. I think their property bubble is what you're outlining there.
Yeah.
And most Chinese people, they're just getting their first car.
Yeah.
So they're not going to want to give up their first car, driving it around and putting gas in. I think the demand for that's going to remain pretty robust.
So that's why oil is I put oil kind of in a special I used to not differentiate between hard commodities and oil, and now I do because I think oil may not decline. Let me put it this way: I'm not necessarily bullish on oil, but I'm not bearish either. Where I'm very bearish on hard commodities. So So I kind of
I agree with that.
Okay.
Yep.
So we do own some MLPs, and we do own some oil stocks. Um, so that sector is fine, and we keep looking at new MLPs all the time. But you want to make sure that when you don't buy a lot of highly leveraged MLPs, because if interest rates go up, I'm not even talking about that their yields will be less attractive compared to bonds, but also they usually use a lot of debt. So you got to be careful when you buy MLPs that are highly levered because the cost of debt will go up, and so they will be less profitable. So go ahead.
So some of them have locked in, like some of the fee-based ones, the midstream guys like Enterprise Products Partners and Kinder Morgan, they've locked in their long-term debt at, I think, 5% for like 30 or 40 years. Now, I don't know if the commodity MLP producing guys like Lynn Energy and those guys get that kind of low-interest debt at long-term rates, but the midstream guys who have more stable cash flows and have fee-based businesses, those guys are getting real cheap debt at long-term rates.
So the one thing you got to be careful, and we used to own Enterprise, which I think is an excellent company. A lot of those companies that trade purely on yield, not on the value of the cash flows, because investors start for yield, just buy anything that has yield. And Enterprise and Kinder Morgan are probably the highest quality company in that space. So therefore, they attract even more investors. So I'd warn your listeners to be careful, because I'd argue that those companies are probably fully valued, if not overvalued, just because the investors who buy them are just chasing yield. Again, I haven't done enough work recently just to say, I'm not sure I can distinguish right now between overvalued or fully valued. But
I would agree with what you said too. Sorry to interrupt you again. I would agree with exactly what you said too. I think there's a lot of utility stocks that are trading at over 15 times earnings. There's a lot of consumer staple dividend stocks, I think, that are trading at 18 and 19 times earnings with limited revenue growth, and their profit margins seem to be at all-time highs. So I think in terms of risk-reward scenario, I don't think there's that margin of safety there for a lot of these companies.
That's exactly right. So I would be very careful. So I don't want to give blanket statements on this. You got to do your homework, and you got to approach it one stock at a time.
Okay, well,
you want to talk about gold?
You can talk about gold if you think there's value maybe in some of the royalty and streaming companies or the miners or any other sector, like a specific couple of technology sectors or something that you think there's some value where there's the stocks have dropped a lot and there's some value based on the cash flow of the business.
So the problem is when you analyze, like let's say when you analyze the oil company, right? For every gallon of oil they sell, it's basically been destroyed, right?
Yep. They have to do with depletion, yeah. That's the only business that has really bad depletion, yeah.
When it comes to gold or silver, etc., I mean, gold actually probably a lot more than silver. Every ounce that ever been mined is still out there, okay, because it doesn't go away. So, and also my biggest problem with gold is something else. It's basically you have no idea what it's worth. Okay, because it has no cash flows. So historically, I kind of dismissed gold for that reason, because I could never understand, what it's worth. But when the gold mining stocks started, declined, etc., I started to look at it just because, that's what I do. I look at things that decline. And what I found is that those are incredibly, and I'm generalizing. In general, they're extremely mismanaged companies.
I agree.
They never see a hole that they didn't want to dig, because that's what they do. They look for gold. They're not run for the benefits of shareholders. They run for benefits of the mining industry, I guess, because they're just look for gold. That's all they do. So they historically have been mismanaged. However, And that's point number one. The point number two, when you analyze them, the different gold prices, they're worth, their their value changes dramatically at different gold prices. And the reason that happens, not just because you take so many ounces they produce times $1,200 or $1,500. It's not just that. What also happens is that when gold prices decline, some of the projects that they were going to complete, they can't complete because the cash flows are much lower, and they need to go out and raise money. So what I found is that it's one of those cases where I see them decline, and I'm sure somebody will make money in them. It just won't be me, because I look at them and I say, you know what, I can see how they can decline another 50%, or I can see how they can double, and I have zero insight into that. However, you mentioned streaming companies like Royal Gold or Franco-Nevada, etc., or so Wheaton, and those companies are they're kind of like the anti-mining companies. They are very good capital allocators, and they run for the benefits of shareholders, not for the benefit of the mining industry. And I like them a lot more. And also, I think, even though short term may be painful for them, they'll probably benefit from what's happening with miners, because miners that will be desperate to get inflows, the miners basically, if the gold prices decline more, they'll need more funds to finance their projects. And the royalty trust will be able to get better deals from them, which will benefit them years down the road. So I like the idea of them. Unfortunately, for me, I don't think they're cheap enough yet. I think if they get cheap enough, I'd like to buy. And actually, that's the businesses I don't mind owning, but I need large margin of safety, and I don't think it's there yet, at least for me.
Yeah, I really like the royalty and streaming companies better than the regular mining companies. The regular mining companies are just so marginal, and the guys who run the companies, they mind the shareholders more than they mind their deposits really well. And they take on really bad debt, and they dilute their shareholders by issuing too much equity, and the costs of doing the business are never end up what they say they're going to be. And the royalty and streaming companies, the four of them, just generate a lot of free cash flow, and they actually are doing deals at these levels. Franco-Nevada in 2008, when the markets crashed, they actually did a deal for only $80 million. They bought a gold stream that was already online, and it was worth a net present value of over $1 billion at the time, because the mining company was so desperate for cash. So it just goes to show you that I think we're going to see those same types of deals if the gold price stays at these levels or goes lower, because there's just not any debt or equity available for mining companies, and the only people with cash are those royalty and streaming companies. They have a lot of cash on their balance sheet, and they have more. Well, I speak with the Sandstorm Gold people, and what they tell me is that a lot of deals are being brought to them, and they have so many, they're trying to figure out which one is the best deal to do.
Sure, yeah.
Okay, well, in wrapping up this podcast here, you talked about Apple. Let's talk a little bit more about technology then, and then we'll let you go. Is there any other technology stocks then you think are safe in terms of their economic moat, or do you think there's not really that much value in the technology sector? Because we look, you see at some of these stocks, the really momentum stocks like the 3D printing stocks, the big data stocks, these things are trading at really high multiples. Where do you see value in the technology sector besides Apple, if at all?
One of the stocks that I think is probably one of the best stocks in my portfolio is Oracle. You can it's probably has the highest competitive advantage of any company I've ever seen. Oracle and SAP. They're really just two companies. They are deeply integrated into the global economy. If Oracle tomorrow basically canceled all its software and said, you know what, they're not going to sell a single piece of software again, and when the contracts expire, you can't use our software anymore, global GDP will probably decline 5% or more, because Oracle kind of runs the global economy. So every time you buy a piece of Oracle software, next year you have to spend 20 cents, for every dollar you spend today, you have to spend 20 cents in support revenues, in the support fees that go to Oracle. And those support fees come with a 93 or 97% margins, back to
Very
Oracle.
Good.
So it's extremely high quality business. I think it's trades about 10 times, roughly about 10 times earnings, and it has net cash position. So that's probably one of my favorite technology stocks that I feel very comfortable with. Will be around 10 years and 20 years from now. And just to finish that, Oracle is run by one of the most eccentric CEOs and chairman ever, which is Larry Ellison. Larry Ellison, basically one of the most competitive person I ever encountered, and you would be sure of that when you listen to the conference calls. And Larry owns 30% of the company, roughly about 30% of the company. So he wants Oracle to succeed. Therefore, if Oracle, so the only way for Oracle to become, let me put it this way. Larry Ellison, I think he's the third or fourth richest person in the world, and he wants to be number one. So the only way for him to become the richest person in the world for Oracle to succeed. So this is a case where you have an incredibly talented CEO, and he's on your side, and you have a great business, great cash flows, etc. So I think it's kind of it's my favorite stock today.
Very good. Now, thank you very much for your time, Vitaliy, and please tell our listeners more about your website since you already discussed your books,
Sure.
and hopefully we can have you back on soon.
Sure. So go to contrarianedge.com, get contrarianedge.com, or you can just follow me on Twitter, which is Vitaliy, Vitaliy, and letter K, Vitaliy K. All right?
Okay, and thank you very much for your time, Vitaliy, and hopefully we'll have you back on again soon.
Thank you, Jason. Enjoyed it. Thank you.